You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball. I'm joined by my co-host, John McEwen, and it's the 11th of January, 2023. And in this week's episode, we'll be discussing B&M, TUI, Greggs, Currys, Next, and our US company of the week is Nike. Before we kick off, though, we did receive a very kind present from a listener and a note thanking us for all the great work we do on the show, which we wholeheartedly agree with. If the very kind person that left the note, we will leave his name out, would like to get in touch so we could thank him personally, that would be very much appreciated. So with that, John, shall we kick off with B&M?
Yeah, so quite topical. B&M, the bargain retailer, they had their Q3 trading update out with group revenue in the quarter up 12.3% year on year to £1.5 billion. And a very good performance across all of the B&M UK categories, both in grocery and general merchandise, with a group sell-through in key general merchandise ranges supporting improved gross margin performance. Overall, UK one-year like-for-like revenue grew by 6.4% to £1.3 billion. Stock disciplines remained robust and allowed the stock reduction of around £100 million year on year. The strong trading momentum continued in B&M France, with revenue up 24.9% year on year to £136 million. In Heron Foods, trading momentum was strong, with revenue growth up 22.5% to £129 million. Full year 23 group EBITDA is now expected to be £580 million, ahead of the £557 million previously estimated. Alongside the statement, the group announced that there will be a special dividend of 20p per share, and the group chief executive, Alex Russo, said, "Our strong momentum throughout the golden quarter across the businesses demonstrates the strength of our unchanged strategy to relentlessly focus on price, product, and excellence in the retail execution. Despite the challenging macroeconomic environment, we will continue to work hard to help both existing and new customers manage the cost of living crisis. The business has exited the quarter well and will remain focused on disciplined execution." In terms of valuation, B&M has a market cap of £4.5 billion and trades at just under 11 times earnings, yields 2.5%. I thought these results were very good. It seems like a well-oiled machine in terms of how the executives have been running the company, and I think 11 times earnings for the numbers that they're putting up, it's very cheap. I think it's probably more likely to be resilient than perhaps some of the other retailers we've got on this week with the wider macroeconomic climate as a bargain retailer. So I like it a lot. Sam, what are your thoughts?
I like it. We have covered it before on the show, and I think we liked it a lot over lockdown. And then as we came out of lockdown, the results did start to dip a little bit. But it was very clearly a very well-run business. Not the most glamorous business. I think it's interesting. They've actually, so about 10% of their stores are actually in France. It's just, you just don't think of it as an international business. Let's see how the France stores are done. Yeah, they're not up much. It's up from a year ago. It was 107 stores and now it's 113. So it's not really growing loads. But no, I thought it was a really solid quarter. I think in the environment they're in, I don't think you'll be seeing like Sainsbury's putting up these kinds of numbers. I think the reason is because part of the problem Sainsbury's has is they've got to keep the prices where they are to stop people moving to B&M. I think in a cost of living crisis, if inflation continues, I think it could be quite good for B&M. So I do like it. And I think the valuation is not unreasonable. I appreciate it might be a bit of a cyclical business, but I think even still, it's a very, very well-run business. And the dividend yield's pretty good now. What is it, 2.5%? So no, I like it.
Yeah, very good. What about our next company, TUI?
No, I mean, we're not usually the keenest on airlines, just for a little spoiler alert. So TUI have come out with their full year results and they've seen revenue double to 7.6 billion euros. It does report in euros, but it's FTSE 250 listed. So yeah, revenue more than doubled to 7.6 billion compared to last year when COVID restrictions impacted performance. High revenue meant underlying operating profit was 1 billion compared to a loss of 97 million last year. All segments returned to profit in the quarter for the first time since the pandemic. For the year as a whole, underlying operating profit increased to 0.4 billion from a loss of 2.1 billion. Holiday experiences, which includes the group's hotels and resorts and cruises, saw underlying operating profit rise 368 million to 433 million for the quarter. The markets and airlines segment swung from a 138 million loss to a 612 million profit. TUI said the performance in markets and airlines reflected pent-up travel demand and a return to a more normal travel environment. The number of passengers doubled compared to last year. Net debt was 1.5 billion lower at 3.4 billion euros. Looking ahead, the group said in markets and airlines, we plan to operate a programme for winter 2022 to 23, close to pre-pandemic levels. Bookings for the winter season are at 134% against the prior winter season and 84% of the winter 2018-19 levels. TUI remains mindful of the uncertain economic conditions. It's worth noting, as shown by the results, it's not just an airline, it does have more of a package holiday business. However, even still, although I don't like airlines, I also don't particularly like the package holiday business. I just feel like I would never walk in and buy a package holiday. I would sort of book flights, book accommodation and do it myself. Like, I know if you want like all inclusive or something, maybe then you'd consider it. But I think generationally, I think less people will probably book package holidays than was the case 30, 40 years ago. In terms of the valuation, the business trades at a PE ratio of 24, which I know they're not quite back at pre-pandemic levels, but I think it's still pretty expensive for what you're getting. There's no dividend. And also, I think the debt is absolutely huge. So 3.4 billion, and that compares to underlying operating profit was 0.4 billion, and that compares to debt of 3.4 billion. I appreciate that might still increase further, but as it stands at the minute, the debt it's like 8 times the operating profit. And that's not even the operating profits, it's the underlying operating profits. It's a huge amount of debt, especially for a FTSE 350 business. I wouldn't touch it. Even if it didn't have the debt, I still wouldn't touch it. It's probably in 2 of my least favourite industries. No dividend, very risky, and I'm not really sure what upside there would be when it's quite expensive. John, what are your thoughts?
Yeah, I think structurally and sort of the fundamentals of the business I don't think are strong. And I would agree with you that I think most people, maybe millennials onwards, would just use the internet. And I think probably in the 21st century, there's little role now for the traditional travel agent. And I appreciate TUI have tried to streamline and have tried to move online, but I think the margins are, as a result, so thin. I wouldn't want to buy a business that operates in that industry anymore. Well, I would never wanted to, but I certainly wouldn't today. And also, it's pretty expensive. So not one for me.
Speaking of expensive, should we move on to something where the products at least are quite a bit cheaper?
Well, yeah, it's a bargain week. Greggs, which is the northern bakery chain listed on the FTSE 250, had a trading update out for Q4 with full year like-for-like sales up 17.8% in company-managed shops. The numbers were flattered by the impact of Omicron last year, but there was a positive reaction to their new festive products. The loyalty scheme and rewards app grew strongly, with which the group thinks will help maintain a strong value proposition to its customers. A combination of strong trading and cost control measures had led to profits to come in line with expectations. 186 shops were opened last year, which included 70 franchises and 39 shops being closed. Extended opening hours were implemented at 21.5% of Greggs shops, staying open until at least 8 p.m. By the end of the year, Greggs had a cash position of £191 million. In the new financial year, the group plans to add 150 new stores to the estate and feels confident of weathering the economic storm that sees material cost inflation in the near term. In terms of valuation, Greggs had a market cap of 2.5 billion and trades at 20 times forward earnings, compared with a 10-year average of 22, and it has a prospective dividend yield of 2.5%. Again, I thought these results were really good, even though they were up against weaker numbers from last year. And I think it's, again, probably like B&M, less vulnerable to the last retailer that we have on, which is Next, from customers trading down. Although, I suppose if you were to look at some of the structural trends, the trend away from the high street, if that were to continue, then Greggs may be a little bit more vulnerable, because generally it lines the high streets across Northern England and increasingly the rest of the UK. And I suppose also, depending on how much of a cost of living squeeze, or how much worse the cost of living crisis gets, may stop even people, or cut back on even their Greggs spending. So given those things, it's probably not that cheap at 20. Well, it's not that cheap at 20 times forward earnings. I think you'd be taking a fair bit of risk on buying Greggs shares at the moment, although we're definitely not at saturation point. So looking at that, I think you could, take one of the two views on it. And I think looking back to, say, 2008, a lot of the coffee shops, so sort of the Starbucks, the Cafe Neros, they weren't expanding aggressively, but Costa was a little bit more contrarian, and they did expand aggressively. People didn't cut back on their coffee spending as much as expected, and then Costa ended up being the market leader in the UK. It's not certain, but it could clearly go one of two ways. I'd be a little bit nervous, so I probably wouldn't buy shares. Sam, what are your thoughts on these numbers and the direction of travel for Greggs?
I think the results are good. I think it's a well-run business. I like the business. What I take is what I dislike is, firstly, I think it's expensive. Secondly, I think it's already fairly saturated. No, I do live in the north, so I can't cross a road without seeing a Greggs. I appreciate there's not as many where you are in Oxford, but
we do have one.
You've got, well, there you go. Well, we've probably got about 20. So I think it's pretty saturated. I don't think it's as resilient a business as people maybe think it is. I don't think it's by any means recession proof. I think we saw in the pandemic, what we saw was a lot of the stores declined with the high street, and a lot of their stores were on the high street. So they were hammered in the pandemic like everyone else. Whereas if you compare that to a business like Domino's, that just wasn't the case. So I think long term, I think they're probably they've got more of a retail side than you'd maybe think, because their fate might rise and fall with the high street a little bit on a good chunk of the stores. And I just think we've covered it before when we've looked at the business in the past and gone in more detail, but the growth targets they've got are very aggressive. They're targeting, I can't remember how many stores they're at now, but I think they're at something like 2,000, and they're targeting 3,000. And you sort of look at how many there already are, and you think, well, do we need another 1,000 Greggs stores? Now Greggs would tell you, yes, we do, but I'm just not that confident about it. So I'd probably, and as well, I just think that the UK listed Domino's is just a better business, and I think it's a cheaper business. I wouldn't get Greggs over Domino's in terms of the business. For me, it would just be a miss, I think.
No, fair enough. I mean, I would say, as someone who comes from the north and seeing how many Greggs there are, and then coming to the south, it doesn't feel like we're saturated down here. I appreciate you're probably saturated up north, and perhaps, I suppose if you see it, Scotland, Northern Ireland, Wales, but anyway, I'm not buying shares, so I won't keep advocating for it. But
all right, shall we move on to another business you won't be buying shares?
Oh, yeah, go on, Sam. Currys.
Yes, so Currys have come out with their half-year results, and half-year revenue fell 8% on a like-for-like basis, down to 4.5 billion, and that reflects declines in both the UK and Ireland and the international business, where they've got sort of a Nordic business, and I think they've also got Greek as well. And it makes up a fairly decent chunk of the business too, which we did go into a bit more detail last time we covered it. And they've put this down to the consumers feeling the effects of the cost of living crisis. The underlying operating profit fell from 88 million to 29 million. In UK and Ireland, underlying operating profit rose 5 million to 25 million as higher margins and cost-cutting measures more than offset declining sales. However, heavy discounting by competitors meant the international business had a difficult half, which saw underlying operating profits fall by 94% to 4 million. Currys now has a net debt position of 105 million compared to a net cash position of 250 million this time last year. This was largely due to a 54% drop in operating cash flow to 60 million as international profitability fell. Currys downgraded its adjusted profit before tax guidance from 125 to 145 million to 100 to 125 million, and they declared a dividend of 1p a share. Interestingly as well, their wages have risen by 16% in the last 13 months. And one of the cost-cutting measures that they've taken includes reducing the brightness of the TV displays, which I thought was quite funny. In July as well, they downgraded their operating margin guidance for the 23-24 year from 4% to 3%. In terms of the valuation, it's trading at a forward P of 6.5, and that compares to a 10-year average of 8.5, and the prospective yield is 5.1%. These results they're not great. I actually think, I'm surprised management didn't say, I know they played the cost of living card, but I think in the lockdowns, when everyone was sat at home with nothing else to do, couldn't really go anywhere, I think a lot of demand for TVs and those sorts of products will have been pulled forward. And I think they're possibly suffering a bit from that now, because there's a lot of people who maybe would have got a TV in the last year, but they got one in 2021 because they were just sat there with nothing to do but watch it. So I'm surprised they didn't play that card, but maybe next time. I think the valuation's pretty cheap. I think it's a decent business, but it is in such a tough industry. And we've seen that in the Nordic results. You know, it's the problem with when you're operating in such a low margin industry, if you get any kind of hit, they've got a drop to revenue at the same time as cost increases. And you've seen operating profits have just fallen off a cliff 94%. And that is a risk with low margin businesses. And it's like when they've cut the operating margin guidance from 4 to 3%. It doesn't sound like much, but that's a 25% drop. So yeah, I just really dislike the industry. I don't think there's anything particularly wrong with the business. I think it's fairly well diversified for what it is. I just think it's in an industry that I would avoid like the plague. John, what are your thoughts?
I mean, I completely agree. I just stay well clear. In the long term, I don't see how it competes with the Amazons of the world, and yeah, for that reason I wouldn't go near it.
Right, well, there's not much more to say on that thing. Shall we move on to a business that we do like?
Yes, so I suppose it probably is one of the favourites of the show, although neither of us do actually own shares in Next, but it's the fashion retailer. They had a trading statement out this week for the 9 weeks to the 30th of December, with sales over the Christmas period better than the market was expecting, and full price sales up 4.8%. Retail sales drove the rise, with strong demand for winter clothing throughout December. These figures did exclude the 74% stake Next has acquired in Joules in November last year. Cost price inflation is estimated to be between 6 and 8%, which it plans to pass on to customers with higher selling prices. With a strong performance, Next has now upgraded its full-year profit before tax guidance by £20 million to £860 million, which is up 4.5% on last year. However, the group expects next year's profits before tax to fall to £795 million, which represents 7.6%, with wage inflation and higher energy costs feeding through. Alongside the planned dividends, Next will return £220 million of surplus cash to shareholders through a share buyback. In terms of the valuation of Next at the moment, it has a market cap of around £8 billion and trades at 12 times forward earnings, compared with a 10-year average of 14, and it yields 3.3%. I thought these results were good, and they do show the quality of the business with its slick hybrid retail structure. It's certainly going to be a tough year, though, with real incomes continuing to fall. And I suppose it's perhaps that the people trade down for what is kind of the middling brand. So I don't know. I think that's probably baked in. Well, it's definitely baked into the valuation at just 12 times forward earnings for a business of this quality. And it has such a good track record. So I wouldn't bet against it. Would I buy shares in it? Possibly. It'll stay on the watch list. Sam, you ready to buy your first next shares?
I do like it. I came very, very close when we covered it probably about 6 months ago, to the point where I was like sort of hovering over the buy button. I just couldn't quite pull the trigger. I think it's done quite well since then, actually. But yeah. I really like this business. I think it's probably the best UK listed high street retailer in terms of when we look at these results. And there are some very good ones, and there'd be quite a few honourable mentions. But for me, Next is just always the best one. I think these results are very good. In the environment we're in, I think full price sales up 4.8% in a cost of living crisis is not to be sniffed at. I really do think these are impressive results. I think the fact that they've beaten the expectations for me would give me hope that they might pull something out the bag with next time. But I also think with the cost price inflation of 6 to 8%, I think they probably can pass it on. I think they're a good enough brand. And I think people do at the minute, they sort of expect inflation. It's just something people are learning to live with. So when everything's going up, I think with a lot of stuff like the homeware and stuff, if you want a nice lamp, if it costs you an extra £2 or £3, I think most people are still going to pay it. I appreciate that combined with the cost of living crisis, it could be an issue, but I think they'll be okay. And I think even if they're not, I think that's why it's so cheap, because this is such a fantastic business. We won't go over them again, but you look at the numbers it's been putting up for sort of the last 10 years, and it's just phenomenal. It really, and it's I think over 50% of its sales come from online now, which it's not just survived it's not survived the decline of the high street. It's actually a stronger business than it was 15 years ago because of the internet, which I just don't think anyone would have predicted that. But the valuation and the yield's pretty good. The yield of 3.3% and a forward P of 12. I think that's very, very good for a business this good, with this good results on the back of a very good year. And I think as well, even if they do have a bit of a decline next year, they do still have the label operation. So that's where they're charging a commission for sales through their platform, which again, one thing I really like the business is the core retail business. I would buy that on its own. It does not make a difference really to the valuation whether the label succeeds or fails. If it succeeds, it's just going to be a bonus, and it could add some, a very nice new revenue stream. And that could hopefully make up for any declines it has next year in the retail side. So I really like it. And I think at 12 times earnings, I think any risks are more than priced in.
Okay, very good. Best one so far. Well, B&M, but that's, I think in terms of quality, Next is a step above that.
I'd agree, but I think B&M is a very well-run business.
Yeah, but we've got some real quality coming up here. Nike, I should say.
Yeah. So, a name that divides opinion. So Nike have come out with their second quarter results, and Nike direct sales were $5.4 billion, and all these figures are in dollars, up 16% on a reported basis and up 25% on a currency neutral basis. Nike brand digital sales were up 25% on a reported basis and 34% on a currency neutral basis. Wholesale revenues grew 19% on a reported basis and 30% on a currency neutral basis. Revenue for the business as a whole increased 17% to $13.3 billion and was up 27% on a currency neutral basis. Revenues for the Nike brand were $12.7 billion, up 18% on a reported basis and up 28% on a currency neutral business, with strong growth across all geographies and channels. Revenues for Converse were $586 million, up 5% on a reported basis and 12% on a currency neutral basis, led by double-digit growth in North America, partially offset by declines in Asia. Gross margin decreased 300 basis points to 42.9%, primarily due to higher markdowns to liquidate inventory, particularly in North America, continued unfavorable changes in net foreign currency exchange rates, elevated freight rates and logistics costs, and increased product input costs, particularly offset by strategic pricing actions. Selling and administrative costs increased 10% to $4.1 billion. Demand creation expense was 1.1 billion, up 8%, primarily due to advertising and marketing. Operating overhead expense increased 10% to 3 billion, primarily due to wage-related expenses, strategic technology investments, and higher Nike direct costs. Net income was 1.3 billion, flat compared to the prior year, and diluted earnings per share was 85 cents, increasing 2%. Inventories were 9.3 billion, up 43% compared to the prior year, driven by an increase in units from lapping prior year supply chain disruption, as well as higher input costs. Cash and equivalents and short-term investments were 10.6 billion, down approximately 4.5 billion from last year, as free cash flow was offset by share repurchases and cash dividends. Dividends of 480 million were declared, up 10% in the prior year, and that's on a market cap of 200 billion, so it's not a huge yield of this one. However, there were share repurchases of 1.6 billion, which is basically like a yield of another 0.8%, I guess, which reflected 16.5 million retired shares as part of the 4-year, $18 billion program. And as of November 2022, a total of 19 million shares have been repurchased for a total of 1.9 billion. In terms of the valuation, the business trades at a market cap of 198 billion and a P/E ratio of 36. I've made a note to mention that obviously Adidas isn't having the best time at the minute because it's just lost the Yeezy brand. But I don't know how much difference that really makes to Nike. I don't think what happens to Adidas, I think it's that good a business. I think it's just, I don't think, and it's like, I think it's about 4 or 5 times the size of Adidas anyway, which always surprises me.
Yeah.
But I think it's a fantastic business. I really do. But at a P of 36 and with the exchange rate, I just think it's too expensive. I'd love to see it get cut in half. And even then, it would still be pricey. But at least I'd take a look.
Yeah.
John, what are your thoughts?
I mean, I think it's a fantastic brand. It's one of the strongest brands in the world. It's never going to be cheap, but you see it delivering the numbers it's delivering. I think you do make a good point about it being particularly expensive if you're looking at it. Well, if you're based in the UK and you're paying up for it in your pounds. But what a quality company! What a quality company! Would I buy shares? I mean, I probably own them indirectly in a tracker, but I would struggle to pay up 36 times earnings with my pounds and shillings.
Yeah, I do think as well. I think the Nike direct business has worked fantastically for them. So sales 5.4 billion and now, and that's on 13.3 billion total sales. So it's over, what's that? Over a third of sales are now coming from Nike Direct. So it's probably getting on for like 40%. It's really, really impressive. But then after that, once it's got to the Nike, once the Nike Direct sales are basically probably at a peak, where does it really go? Because it's a brand everyone knows. It's pretty saturated, I just think. And that's why it's such a risk at 36 times earnings.
Yeah.
Because it's got to grow a lot from a very large base to justify the current valuation with a market cap of 198 billion. So I don't know, to pay that, I mean, I wouldn't expect a market beat in return from it, but I guess you might not be buying it for that because it is probably, obviously it's a very high quality business, isn't it? But
and I think it's an interesting point that you make, the sort of, I suppose the direct consumer sales, because that's something that in other companies that we've covered, like JD, that does worry me a little bit, holding those sorts of retailers when you've got Adidas and Nike pursuing that strategy.
Yeah, I agree. But
obviously very good for Nike and Adidas and makes complete sense.
Yeah, but then in the JD results at the minute, it's not really coming through, is it? It seems to be doing just fine.
It's not. It's that thing that worries me about the investment case for some of those.
Yeah, I do sort of think longer term, is the norm just going to be you go on, you almost like design the trainers you want, and then it just arrives at your door. And you don't need to go to the store because they know your shoe size completely. Because once they've got it once, they might know perfect. Like they'll know for the rest of your life what your shoe size is. I mean, but in the future you could have it. So it's like you sort of send them your actual measurements and stuff, and they can make your perfect shoe almost. And you can design it. Like there's just so much potential for the direct to consumer. But it's not long term. It's not great for JD. And then it's like JD and places like that, they're almost like cool places to go, cool places to shop. they don't have Nike and Adidas. If Nike and Adidas were to pull out of there, that's it. Because I think people are going for those brands. I think if they're not there, I think a lot of customers don't go at all.
No, I'd agree with you there, and that would be what I'd be particularly apprehensive about with some of those other retailers.
So, of the 6 businesses we've covered this week, B&M, TUI, Greggs, Currys, Next, and Nike. If you had to buy one, which one would it be and why?
I mean, Nike would be my favourite company, but would I buy it? Probably not. Too expensive, as we've just discussed. Then it would be, well, then it's, I suppose, a toss-up really between B&M and Next. I think in the coming years, well, next, so let's say 1 to 2 years, possibly seeing B&M outperform. But I don't really buy a company for 1 to 2 years. I'd buy it for 5, 10, or ideally a company that could hold forever. Next would be that quality retailer that I would go for and be something that I would sleep well with. Sam, what would you go for?
Without being boring, very, very similar, and for very similar reasons. So I think Nike's too expensive, but I mean, it's just such a fantastic business. B&M, I think it's a very well-run business. I do like it a lot, but I think Next is just a fantastic business. I really, really like it. And it's one where the more we've covered it on the show, the more I've come to like it as I've got to understand it better. It's like I said before, I think it's probably the best run retailer on the high street in the UK. I think I really do like it.
Well, it didn't make it to the fantasy portfolio, but perhaps it should have done.
Yeah, that's a good point, actually.
We've got a lot more reporting that's happened this week and into next week, so it'll be a busy one for next time. We'll see you again then.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.